stop trying to backtest everything down to the penny. What people should focus on is where the stock is going. Where do you think the stock is going? And then you should be using the tool options as a way to leverage that only when it has an opportunity to do that.
All right, we are live and people are starting to log in. Welcome everybody. I'll give you guys a second to log in. With us, we've got Felix again. I'm so thrilled to have met and become friends with Felix Frey. The level of knowledge that this man has for options and his ability to not only explain options and understand options, but to break it down in a simple way that everybody can understand. It truly is amazing and such a blessing to have Felix with us again, man. Thanks so much for being here and joining us today.
Thanks a lot, Mike. I really appreciate for you guys having me.
Yeah, absolutely. Well, when we were talking a little bit before we opened up the broadcast, you're out in Vegas right now.
That's right. Yeah, it took a couple of days time off.
Really appreciate you hopping on and doing this for us while you're on vacation, man. That speaks a lot to you and your character and everything.
Sure, no problem. No problem.
All right.
Well, let's get started. I know you had a couple of questions.
First question that we have was about using options for longer term moves. This question came from one of our Mara Elite members,
Sure.
Anthony. He wants to use options for longer term moves, like 3
Sure.
months or more, like at least 3 months.
Okay. Yeah, no, I get it. I understand it. It is a question a lot of people have, timing, and you hear many different things from different people about leap options and long-term options versus short-term options. Maybe I take 2 seconds just in case people don't understand a little bit about what I've done and what Options Geek is about. I built Options Geek because I saw this a little bit of confusion or maybe a lot of confusion in the options market. And I have a simple message, and that message is that the top hedge fund managers in the world, the top guys in the world that people read about, the Bill Ackmans of the world, Carl Icahns, Steve Cohen's, even George Soros, these guys use options in a very specific way. Okay, and that way that they use options is really a process. And in the industry, in all the available education that's out there, all of it, okay, has sort of missed the mark. Okay, so my messaging is very simple, that the industry, in a way, has failed the average investor because it hasn't given it. There's a mismatch between what the average investor and who the average investor would like to be, and the education that is trying to get that person to the end goal. Okay. My contention is that 99.5% of the world that are trading options, they want to be like a George Soros, a Steve Cohen, a Bill Ackman, or Kyle Icahn. They want to use options for leverage and because there's limited liability. What do I mean by that? Limited liability means that they know how much they can lose on an option because they can buy an option. The top guys in the world, they generally buy options. Okay, and most people think that because the industry is most people promote selling options, that's already in a confusing point. The top guys in the world generally buy options. They buy it for the limited liability. They know what they can lose, okay, and they buy it for the leverage, right? They're trying to turn $1 into $3, $4, $5. That's why they go towards that product. It's an amazing product for them. Okay, now, how do you use the product? And that's what we're going to talk about today. And your question goes right to the heart of how do you actually use the product in a way that you, Michael, or your viewers can get an advantage, right? How do you get that advantage? Okay, so you asked a question about long-term options. And again, I'm going to tell you that what's out there, many people say, you want to buy long-term options, and then some people say, no, you don't want to buy long-term options because long-term options cost more money. They have more time value, if you will. Okay. So let's go to time value in an option, right? When you buy options, you are buying some amount of time, right? Because there's an expiration, okay?
Right.
And when you're buying long-term options, the time is longer, so the option will cost more. I don't want to say it's more expensive; it will cost more. So these terms, cheap and expensive, also cause a lot of confusion. So the option is going to cost more longer term, okay? Because you're buying more time. Buying more time means there's more possibilities for the stock to go way up or way down. And you don't get that privilege of putting up a small amount of money when a stock could actually move, a crazy amount. Take Tesla, for example. Tesla's a $450 stock, $450 stock. Where's Tesla going to be in 1 year? Geez, it could be 1,500 the way it's moving, right? Or it could go back to 100. No one knows, right? And so if you're going to buy time in Tesla, well, the market's smart enough to understand that Tesla moves a lot. And so they're going to price it higher. Okay, so longer term options, more time, more possibilities, more probabilities of market going up or down. You got to pay more money. So the question is, is it worthwhile to use long term options, or is the time too much? Now, what everybody needs to understand about options, and again, what I'm in my education, what I tell people is to stay away from the Greeks and stay away from implied volatility in general. In general, what matters is price, the options price today. Okay, what you see the price. So on an options chain, you will see a price, and that's what matters, right? This whole notion that there's this theoretical price of what that option should be, okay, is hogwash. Okay, it is what it is. Okay, just because it should be $11 and it's trading at $11.50, what are you going to do with that information? Okay, it's not really what you're looking to do. And that, again, that's part of the old education. The new education is basically saying focus on the $12, because that's what you're going to have to pay. Excuse me, that's what you're going to have to pay in order to actually play the game. Okay, you take all the theory you want, but at the end of the day, you got to pay $10. Okay, $12. Okay, so the long-term option in whatever name costs, let's just call it $12. Now, how do you analyze that? How do you think about that? Well, it always boils down to a hedge fund manager. It always boils down to risk reward. Now, everybody understands risk reward at a high level. The greater the risk, the more reward. You want to get a large reward, you're going to have to pay a little bit more. So that notion, that's a great start. But now, how do you take that 30,000-foot view and bring it down to options? How do you actually say that $12 that I can spend on a 1-year option on $100 stock? Okay, how do I manage that? How do I look at that and say that's good for me, or that's not good for me? Right? It's too expensive or it's too cheap. So how the top guys in the world do that is they focus on where they think the stock is going to be. So let's take $100 stock. We'll take a $110 call option. So the $100 stock is a technology stock, $110 strike, 1 year. Let's just say, stick to our assumption, costs $12. Okay. So some people will look at the break evens and say, well, I start making money at 110 plus 12, which would be 122. Okay, so call options are going above 122. That's where my break even price. But that's just that price is just a simple price that says this is where you'll start making a little bit of money at expiration. Okay, what the top guys in the world do is they don't look at that. They don't start analyzing the options. What they do is they focus on the stock. Where is the stock going to be in 1 year's time? Because ultimately, by the end, at expiration, the time value that you see today in the options, that time value at expiration is always zero. Okay, so at expiration, the option is always worth either zero, or in call options, it's worth where the stock price is less the expiration. So if the stock goes to 200 and you have the 110 calls, then that option is going to be worth $90. Okay, these are basic concepts in options. Okay, and if your viewers don't understand that, then I have in the education, even in the free education, I have one lesson, 22 minutes, that explains a lot of this. okay, calls and puts and whatnot, just in case, they're very beginners. But at the end of the day, if the option goes from 100 to 200 and that 110 call is worth $90, now you paid 12 or 10, let's call it 10, make it easy number, $10. You paid $10 for that and it's worth 90. You made 8-1 on your money. Tremendous trade, great trade, okay? But is the stock really going to go to 200? Okay, that's where, again, the top guys in the world, they're focusing on. They're not focusing so much on this analysis of the option premium, how much it should be worth, what the implied volatility is relative to historical, all the different things that people are talking about. They're just focused on, it's worth 10, I'd have to pay 10. Where do I think it's going in the next year? If I think it's going, doing fundamental analysis, technical analysis, because people then ask the question, how do you know where it's going, right? Well, you use all the different processes that you would use, whether it's day trading, swing trading, or long-term investing. So I think $100 stock is going to be worth 150. I'll give you a perfect example right now so we could put actual numbers. It's close to $100 stock. Fiserv, FISV, okay? Fiserv is a stock that has been trading. It's trading well. It has a large holder. They did a secondary. The stock has held sort of that level down a little bit and then bounced back up. They have a little nugget within Fiserv is an app, if you will, called Zelle. Okay, maybe everybody has heard of Zelle. Zelle's in every bank. If you go take money out of the bank, you can say it's peer-to-peer distribution of cash or money or peer-to-peer payments. Peer-to-peer payments. Okay, so if you go to Citibank, I don't know where you bank, Citibank, Wells Fargo, any one of those, you can, instead of wiring money from me to Mike, $1,000, I could just use, and that costs me $15 or $10 or whatever they charge you. Zelle does it for free. Okay, so peer-to-peer cashless payments. And if you look at Square has an app called Cash App. Well, Square's stock price has gone up tremendously over the last year. People are excited about this Cash App. Well, Fiserv has Zelle, and Zelle's been picked up by many of these banks. It's $100 stock, $105 stock. And, there are people buying longer term options in Zelle. They're buying March and January 2022, I believe, but a lot of March options I've been seeing. And they're paying around $12, $15 for these things. Now, if they're paying $12 to $15 on a $100 stock with the $100 calls, they're thinking in their mind, they got to be thinking 140, 150. And why do I say that? A core belief that your viewers should start understanding and have, okay, what I teach the members at Options Geek is that a hedge fund manager would not buy an option if they couldn't make 150 to 400% returns, okay? So if they're going to pay $1, they're going to want to at least sell that option at $2.50 to $5. Otherwise, they would just buy stock. Okay, so they're not trying to game a dollar option for 20 cents or 25 cents. They're not trying to say, you know what, I like this trade. I'm going to spend $5, and when it goes to 6, I'm going to sell it. Because I made 20%. It's not what they're doing. They're only going into options when they find this big move. So whether or not that big move is in a week, in a month, in 4 months, or in 1 year, okay, the top guys in the world, they're focusing on where it's going to be in that time frame and how much that options costs, and then they're doing this risk reward analysis. Because if I know the stock, or I believe the stock Fiserv is going to 150 because of this Zelle app, and I think over time people are going to catch on, the earnings are coming out in a month, they have an investor meeting in December, they're going to start highlighting this Zelle. Okay, and it's in every major bank, and its competitors are doing very well. To me, it's only a matter of time before the market picks up Fiserv and says, you know what, we like this name, we're going to get long this name, we're going to get long this name in a big way, and going to drive the stock higher. So let's just say it can get to 140. These people buying these calls, they're paying $12. 12 to 140, that option is now worth $40. 100 strike was worth 40. So they make $28. So they make 28 over 12, which is about almost 2.5 times their money, 250%. That makes about sense. So I'm looking at 140, 150 is probably where they think the stock is going. That's how you look at options, whether it's long-term, short-term, or daily, okay? It's about where it's going, what that option will be worth, what you're paying today, and then you have to ask yourself, is that good enough? Okay, that's the key part. For example, if I told you, let's just say this Fiserv trade, someone buys the 100 strike calls for $12, they think it's going to 140, okay, and or $10, they think it's going to 140, so that's 30 to 10, okay, 3 to 1. The question I have is 3 to 1 good? Now, I'm going to take you away from stocks for a second, because that's a question I would ask anybody. But if I said to you, you know what, Michael, I got a trade for you. I got something for you. 35 to 1. 35 to 1. Would you do 35 to 1?
35
Sounds
to
pretty good.
like pretty good odds. Yeah, but
Sounds
what's the
pretty good.
probability?
Okay, so what? Yeah, so pretty good odds. Damn, that sounds pretty good. Well, you know what? I can bring you downstairs with my camera, and there's a roulette table, right? And we could put it on your birthday. You could pick the number. We'll play all day, and I'll just take the other side of whatever you want to do. Because at the end of the day, they give 35 to 1, but you know, oh, that's no good. 35 to 1, that's no good. You know, that's a losing trade over time. See, you know
Right.
that 35 to 1. Once I told you it was a roulette table, you said that's no good. 35 to 1, no good. So when you look at options, and we looked at a trade right now with Fiserv, and someone's paying $10 and they think it could go to 140, and you're saying to yourself, oh, it's 3 to 1. I ask you the same question: is 3 to 1 good? Now it's you. Right now, you're not going to know that. That's what I teach. I sort of teach you whether or not 3 to 1 is good, and I built an options chain, okay, that sort of does all of that for you. Okay,
Mhm.
is it good enough? Is what you're thinking good enough for an options trade? Okay, so the whole goal for me was to get the millions of investors out there to stop focusing on options analysis. Okay, stop trying to backtest everything down to the penny. Okay, what people should focus on is where the stock is going. Where do you think the stock is going? Just like in trading, you know, I'm buying this because I think it's going higher here, here, here. Well, that's what you should be focusing on. And then you should be using the tool options as a way to leverage that only when it's has an opportunity to do that. Okay. So I see a lot of your ideas are on swing trades. Oh, I like this for the next 2 weeks. So there's an earnings, or there's an event, or there's something, or there's a bull flag, and it looks like it's creeping up with that bull flag, which could extend it for another $10. Okay, that could be a stock trade. But now you might have a question and say, well, maybe it's an options trade. Maybe we can actually use an options trade here as opposed to stock. Okay,
Right.
and that's what I've built. So if you'd like, I'll show you very quickly what I'm talking about and how to think about things. Okay, so let me share my screen.
It's such a fantastic tool. Like on some of the deep dives too, when a question pops up of like, oh, like, is this an options opportunity? We'll pop this open and take a look, and
Yeah,
we'll walk around.
good.
So,
Try Fiserv. Put Fiserv. FISV. Yeah. Now click go. Now in the expiration, I think let's try March. Go to March 2021.
all
Okay.
right,
There's been some March buying, I believe. Okay, there you go. So see the 100 strike calls, the 13,000, 100 strike, 113,900, about 14,000. They've been
yeah,
buying these over the last couple of weeks. Okay, so if you let's click on remove shading for a second on the
uh,
top right corner. Yeah, right there. So click that. So you could see it. So this is your standard options board, right?
right,
What I did was I added the RR dollar on the sides. Okay, so that's an important number. That's sort of this embedded risk reward number. It's an embedded number. So for calls in general, for calls, you would want your target stock price to be above that number. Okay. And for puts, you'd want it to be below this risk reward dollar number. Okay. That the machine is going to take your thoughts, and it's going to sort of place it somewhere around this board. Okay. So you could take the target stock price, and let's just call it, we think Fiserv is going to go to 135. Okay. 135. Okay. And it's going to pop up right around here. Okay. You see we're at the 110 strike call. It's basically saying at 135, you know, you're thinking 135 with a confidence of about 80%, which is about right. I defaulted there because that's where it should be. But you could play around with that confidence bar to sort of move the pointer, right? But let's just say, yeah, if you click that, yeah, right, you can click it all the way down and it'll move it lower. If you click it all the way up to the high confidence, 100%, it's going to move it higher, right? The more confident you are, the way to read that is the more confident you are. Let's just say you put it at 100% confidence, right? You are 100% sure it's going to be 135 at the end of March expiration. Okay. So click on, you see where it says calls and puts, the I button right there. Click on that. I. Yeah. What that's basically telling you is that it's trying to choose for you the highest actual return. So out of all the options you could have chose, if you know it's going to 135 at expiration, then the best return is at the 120 strike. Okay. That's the best return. Now let's go from 100%, take it down to 0. Okay, you have zero confidence. You're basically just going with sort of what Black-Scholes is saying, and the odds that Black-Scholes is given. Black-Scholes is saying, okay, we're going to give you this using this probabilities. This is what we think your edge is if you think 135, and that says, you see where it says edge in the green, the middle column, 50.93. Okay,
Right.
so if you're just going by what the Black-Scholes formula says, then the 75 strike is going to be your strike. But that's not where the top guys in the world they're buying. Okay, so the confidence bar, move it back up to 80.
Okay.
Okay, the confidence bar is going to be between those goalposts, if you will. It's going to be between 75 and between 120. We've narrowed it down. Okay, now what's going to happen is if you click the add shading button now, what I've tried to do is I've tried to highlight it where the top guys in the world are generally buying options. Okay, generally buying options. So they're generally buying options between the 110, 120. Now if you go back to let's go back to the main screen, the back button right there. Yeah. So now at 110, if I think 135, they'll be buying options there. They were buying these 100s and 105s when the stock was a little bit lower. Okay, so I can tell you that they were buying it right near where this, I call it the window of opportunity. So you have this window of opportunity. So all you have to do, okay, out of everything that we just said, all you had to do was basically say, I think Fiserv is going to 135 by March. I think my confidence level is going to be somewhere around 80 because this is one of those trades that I really like. Okay, people ask me all the time, well, tell me about this confidence level. How do I determine
What makes you
confidence?
so confident?
Right, exactly. Well, think about this. I always explain it in this way. It seems to get the point across. Steve Cohen has 100 options, 100 stocks in his portfolio, right? 100 stocks. He only uses options on 10 names, 5 names. You look at any of these guys, go look at their 13 Fs. They only use options on certain names. So the question you should ask by seeing anyone's portfolio is, why just 5 names? Why not use options on every name, right? And it's because they found opportunity in those 5 or 10 names. I'm trying to describe to you what that opportunity is. Now, the confidence is the confidence on your target stock price. So let's take an example of let's take any stock that has a bull flag. Bull flag might be $10 wide, right? The flag might be $10 wide. If it breaks that flag, okay, you could sort of reasonably assume that this thing is going to break with good volume, should trade up $10, right? The bear flag, $10 wide, with a, say, $20 post, it should probably trade up $10 at least. And then really, if it has momentum, trade up that $20 post all the way up from the bottom. So it should trade, your target might be $10 higher than where the top of that flag is.
Okay.
If depending on that technical setup, you might be more confident on that one when it breaks out than on some other stock that's just sort of languishing around and you're like, okay, it's starting to turn. I think if it turns, it's going here. Some setups for you, everyone has a different process. I'm talking about techno analysis now, but other people have different processes. Before earnings, stocks, this stock generally goes up $5, or 5% or whatever it might be. These are processes, and as options are not about the options analysis. When you're buying options, it's about the target stock price. It's about where do you think it's going. And then I built this machine to sort of do all the calculations and the iterations fast enough so that you could sort of see it in real time. Okay, so confidence, I say, if Steve Cohen's only using options on 10 positions out of 100, he's highly confident about where he thinks the risk reward is on those stocks. Okay. He either has a good idea that the stock is going to go here, or if there's a bad news, the stock is going to go down significantly down to here. And he's not willing to put, he's either leveraging a stock position. So he might have 1 million shares of XYZ stock. And then on top of that, he wants leverage because he believes that it's going to go up, a lot. And that's what they're doing. And that's how they're playing the game. So this machine was built to think just like these guys. Now, what I find interesting, you had a point before, and again, I guess let's go back to the original question so you can ask the next question. The original question was long-term, short-term, how do you determine when long-term is good, when it's not good? Again, it always comes back down to this machine. You could just take a longer term, a longer expiration. And the prices are higher because there's more possibilities. But again, it's just going to force you. If you want to buy longer term options, the thinking is going to force you to have a higher target stock price, right?
Well,
It's
what if
always
you're a trend follower, right?
what's that?
What if you're trend following and you are like you're not sure when it's going to hit the target price? You just know that the stock set up an XYZ pattern. When it breaks out, you get in, and then you ride the trend for as long as it's going to go, and you don't really have a specific time frame. Would
Totally
you just
fair.
look at your overall I tend to be in trades for a few weeks, a few months, and then have that be the default?
I
Like,
want I
is
want
that a way
you
to
and your
do it?
listeners to I want you and your listeners to really understand this point.
Mhm,
Options are a tool for leverage that
mhm,
need three things. They need a target stock price.
mhm,
They need an event. They need some sort of time frame. And usually the top guys in the world use an event to anchor their position. Okay.
mhm.
And they need confidence. They need some level of confidence or understanding that this is one that I am very confident that I like the trade. They need those three things. Options are not a tool to just say, oh, I kind of like this trend and I just want to kind of ride it for a little bit and just let it go. It's not the way you should be really using the product. Okay, because there's time. Let me say it another way. Okay, if I was gonna flip a coin, okay, and I was gonna flip it 3 times, and I said to you, you'll win if you win it, if you call it right 3 times, okay, which means you're gonna take 3 guesses. Well,
Mhm.
if you take it on 1 guess, it's a 50-50 shot. If you take it on 2 guesses, you're only going to be right 1 out of 4 times. And if you take it on all 3 guesses on the 3 turns, you're only going to be right 1 out of 8 times. Okay. So each guess, okay, knocks you down by 50%. Okay. 50%. You went from 50% 1 to 1 on a one-time guess. Now you got to hit it twice, 2 guesses. That's 1 out of 4. Get 1 out of 4. It drops your probabilities of success. And on the 3 guesses, you're only going to hit 12.5% of the time. So
Mhm.
each guess is damaging to your ability to win any probability game. Okay. So you don't want to be guessing. Okay. So when I'm telling you that you need target stock price, you need a confidence level. Okay. And you need some element of time. The top guys in the world understand the concept I just told you about guessing too many times. You don't want to guess. You want to reduce the guesses to one thing. Okay. And that's what they do. So they pick a target, they pick an event, they pick something that they can latch onto to say the perception of this stock will change, or the opportunity will be revealed at this moment, whether it's today's Apple conference, right? They have a 5G, everybody knows that. But what if they have like a 5G plus that nobody even thought was possible? And all of a sudden it's like, whoa, but someone anticipated that. And then the stock trades up to 130 this afternoon. Nobody knows, right? Except if someone sort of has done that and done the analysis and says, no, I think they're going to come out with 5G plus this other fantastic product. I don't know, but that's fundamental analysis. That's digging in, talking to consultants. So that's what you're always trying to focus on an event to avoid this guessing process of, I just like this trend. I don't really know where the stock is going, but I know that over 1 year's time, it'll probably go up. Well, in that scenario, then long-term options might be good, but you're leaning now more on fundamental analysis, okay, and
Mhm.
moving away from technicals. So the longer time frame you're going, the more you're leaning on your ability to analyze a company and have sort of this fundamental analysis that backs a price target of 140 or 150 in our example, whatever it might be. Okay. If you're talking about 2 weeks or 1 month or a swing trade, then you're talking about more technical analysis. You're moving closer to technical analysis because yes, fundamentals too, because maybe there's an earnings announcement and you believe that Disney Plus was, going to kill the numbers that were expected, and Disney's going to go up for whatever reason. And then you can use technical analysis to say this is my pointer. But you're either in that phase of fundamental analysis when you're dealing long-term options, which you're saying, I don't know where it's going over the next 3 months, but you know what? Fundamentally, this is sound. The stock Fiserv is going to 140, 150, and it might take a year, and I'm not going to look at it, and I'm fine with that. Okay. That's you go into the fundamentals curve. The closer you go, the closer you're going to start leaning more on technicals and maybe some data, mining and how things move, back testing and whatnot. So these are the things to think about. But it's you know, most people are trading between 1 and 3 month options. Okay, 1 and 3 months. That's where the majority of the volume is, and they're anchored by an event. These people are looking, the best guys know what they're looking for, an event, because they don't want to guess. They don't want to guess. They want the event to reveal something that will change the perception of the stock and make it move out, break out, whatever it may be.
Mm. Uh, we had a few questions come in
Sure.
around that. Matt, let us know if what Felix already said answered your question. Um, while we're waiting for that, there was another question that came in before the webinar that we got from the audience, which was how to position size with options. You had already mentioned that with options, you know what your maximum loss would be, right? Like you lose your
Sure.
full premium. Is that how you would go about position sizing, or well, would you say that, oh well, when I lose 50% of the value of the premium, like I'm position sizing based off of that? So so if I've got a $1 call and I wanted to risk a dollar, well, I could buy two calls, right? Because 50% of each.
Yeah, I would stick to, at Options Geek, I constantly teach people to 50% is about that right level, 50 to 60%. Um, and 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 the reason, again, let me give it to you in a different way. You start with $1 option, and you're buying it because you think it's going to go to $3, right?
Mhm. Right.
Okay. So dollar option, you think it's going to $3. Okay. Fair. However you got there, that's fine. Okay. And we're on the chain and it works. Okay. We're going to buy this option. We're wrong. The stock, let's say we're buying calls. The stock goes down. That option goes to 50 cents. Okay. Now, the question is, do I stay in? Do I get out? Like, how do I sort of think about this? Well, I tell people to ask themselves this: how many times do you see options go up 500%? It's not an everyday affair. I mean, it's 500% is hard to hit on options. Even though it does happen, it is hard to find and hard to hit. Okay, and it's not going to happen often. But 500%. That's our level that we want to. I ask people and they say, no, it is hard. It is hard. Okay, so the stock goes from. Now let's go back to our example. Stock goes from $1 to 50 cents. We thought it was going to go to 3, right? And from $1 to 3, that's 200%. Not as bad. Okay, but now we're at 50 cents, and we want the 50 cents to go to 3. Well, 50 cents to 3 today, if we bought that option today at 50 cents, that would be a 500% return, right? 50 cents to $2.50 higher would be a 500% return. And you just told me that 500% return is pretty damn hard. Okay. So what happens is, because of the leverage game and the math, when it goes from $1 to 50 cents, it becomes that much harder to get back to that original level of $3. Not that it can't, but you can't think about what you paid. You paid $1. you have to think about what it costs today, 50 cents. Okay. And that's how you start thinking of, when you start thinking about the math, you start thinking, wow, 50 cents to $3 is really tough. Now, if you want to play it for a bounce, and I have no problem with that. If someone says it's getting close to 50 and now it doesn't reach our stop and then it goes back up to $1.50, I would start thinking about that option as 50 cents to $1.50 is down. That's a 200% return. I might be happy taking a little bit off a little bit sooner than I was if I started at $1, went down 10, 20 cents, which is down 10, 20%. My first initial take is to try to take it from $1 to $2 and take some off. But these are the types of thoughts that you should be, thinking about and how to manage it. I would say when you're looking at the risk, you're gonna find a level that you feel comfortable with. Again, 50 to 60%, call it 50% is about right. I would use the risk as 50 cents on the dollar or 50% of the premium, but you have to stick to it, right? And some days it's going to gap and you're not going to hit it's going to be 65, 70%. But, in general, you're trying to be around 50, 60%. And that should be your risk. And so if you're risking 50, 60 cents on the dollar to try to take that dollar and turn it into 250, $3 option, well, then think about what you're risking. You're risking 50 cents to make $1.50, $2. So it's about two and a half. Call it 50 cents to $1.50 is 3 to 1. But if you're somewhere averaging around 60 cents down, then it's about 2.5 to 1.
All right. So let's flip it the other way, right? So let's say you buy the option and the price of the stock far exceeds where you thought that it would go, right? Like now, when do you start selling? Like how do you buy? Do you buy with the intent to have a way to scale out, so you're not just buying one or two, but like you're buying like 10 or more, so that way you can piece out on the way up? And how do you?
Absolutely. Yeah, absolutely. So one of the big things that the big questions is how much money do I need to start to trade options? It's one of the most frequently asked questions. And it gets to the point that what you're talking about, which is layering out. In another thing they teach, if we can agree to this, that no one can buy the bottom or sell the top consistently. Okay, no one. Computer, no one. Okay, if we agree that no one can do that, then by definition you have to agree that your first purchase of anything is going to be a loser 95% of the time, 98% of the time, right? Because you purchased it, you didn't buy the bottom, you can't buy the bottom consistently. That means your first purchase will be a loser 95 to 98% of the time. Okay, and you have to believe that, you have to understand that. Okay, so what I tell people is, instead of buying your, say you have 3 lots to buy, instead of buying all 3 at one shot, buy one. It's likely to go against you. Okay, then you layer in, buy the second, and then you layer in and buy the third, and you do that balance. You have some average price, you lock in a stop loss off that average, and now, again, simple math. You're always trying to, you're only in options to try to make 150, 200, 300, 400%. All right. That's why you're in it. So if it goes up 20 cents, you're not trying to sell it. You're trying to be in this trade to actually make, that dollar go to, say, $2. At $2, I tell people just take off 1/3. Okay. Why do I say that? Well, again, simple math. If you have 3 positions, okay, 3 positions, and three contracts, and you paid $1, and the option goes to $2. If you sell 1/3, you've taken off 66% of what you put in. You're
Right.
taking off $2, right? $2 on one contract. You only put in $3 for the whole trade, so you've just taken off a significant amount of your trade, of what you put in. And it allows you to breathe a little bit and allow the rest to run. But it also saves you if it starts to turn, and then you could just sell off. You have a stop loss, a rolling stop. So if it goes back to even, I like it to go back to, if it goes back to even, I like selling the other 2/3 at even, and then you still end up with a profit of 33%. Okay. So that's one way to look at it. Or you can go back to the stop. So you would take off the one lot that you took off at $2, and then you take off the second and third lot at minus 50 cents, okay, net, you're still up $1 in profit on your $3, okay? On the 50 cents, sorry, net, you're taking off 50 and $2, you're flat. You didn't lose any money. The other way around, if you took it off at flat, so an option goes from $1 to $2 and then goes back down to $1. If you get out the 2/3 at $1, then net, you're up. You've taken off $2 and then $1, that's $4. You put in only 3, so you're up 33%. So it's just a nice way to allow yourself to breathe and to make it difficult to lose on that position. And then you have 2/3 of the position allowed to run. So you have a breakout, something trades and trades up today and it's breaking out, say, and it goes above this breakout level. You could say, all right, well, you know what? I think it's going up to here and this option looks good. And I'm going to play this option, up for at least a third, trying to get a third up 100%. And that's really the game. The game is to try to find that level. I think it's 100%, and I think stop at 50%, where you are managing the losses and you are trying to sort of take money off as it's winning. Now, you asked how, that's unique to everyone, where there's no magic formula to say, I'm going to take it off at 100%. I just tell people 100% on your first third is good. And then after that, you can let it run. You could be more aggressive and let it just keep running, or you could be more conservative and say, okay, I'm trying to average 150 to 200%. So I tell people 100, first exit, 175, 200, second exit, and then let the last third, you can go a little crazy with the last third and let that run to your heart desires, that's how you should be thinking about it. Thinking that you're going to always catch the top, that's probably not going to work. It's probably not going to work. So you should be finding sort of your levels up front. You should know up front where you want to get out, right? Because you're making the determination to buy that option based on target stock price levels. And so you're going to have to take some off. I'll put it to you another way. And I ran into this problem even as I was a top trader at one of the investment banks, and I got to the hedge fund, and my manager would yell at me for this because I thought, here I bought an option, okay? He's a billionaire, so I would listen, but I thought he was wrong, but I was listening, and then I was stubborn. It took me a few years to actually realize, wow, he's really right. Like that makes no sense what I was doing, right? But I was thinking in a way because I used to trade volatility at the bank. So you buy an option for $1, and you think it's going to 5. You think the option is going to 5. And, I was right on something on the name, and he walks in and he says, congratulations. The stock was up big. And that dollar went up to $3.50. Okay. So it went from $1.350. And he was so excited for me. He's like, that's great. He goes, did you sell it? And I said, no. I said, I think it's going to 5. He's like, huh? Well, you didn't sell any? No, I didn't sell any. I think it's going to 5. I bought it for $1. I think it's going to 5. So he started yelling at me. He goes, sell that thing right now. And then I would fight with him, and I'd say, no, I think it's going to $5. And I was very adamant that I thought everything was working well. The news came out. I forced me to sell it, and I would get pissed, and I'd be sitting there fuming, and guess what would happen? It would go to $5, and then I'd be really pissed off. And I said, see, you cut me out of this position. And he finally, because we'd have this argument a lot, and sometimes I'm right, sometimes he was right, sometimes I'm right. But at the end of the day, one time he said, because he saw me getting frustrated, and he said, Felix, would you buy? He just asked me a simple question. He goes, you're a smart guy. He goes, you paid $1, great. It goes to 350. He goes, let me ask you a simple question. You walk in today, would you buy that option for $3.50 today to make the other $1.50? And I said, the minute he asked me that question, I thought, man, he's right. And I said, you're right. That's all I said. I said, you're right. I wouldn't come in today, pay $3.50 to buy that option to make $1.50 because I thought it was going to 5. And he said, if you're not going to come in today and buy that option today, then you have to think that you're going to sell it. But if you're not buying it, then you have to be active. Options are about being dynamic, right? And so you always need that buffer. that margin of safety, if you will, of what you plan on making. And if you start it like this, and as the stock starts filling up the tank with profits, right, what's happening is you still have that money on the table. Okay. And now the risk reward is starting to shift, right? Your whole risk reward profile, $1 to make 4 is different than 350 to make $1.50. Okay. The risk reward has shifted. Okay. And that's how you start analyzing it. That's the way to think about it. And so again, the tool is doing that for you. It's trying to help you understand when that bounces. Now, as the stock goes up, you're going to start the pointer is going to start moving away from the tool. Okay. So so instead of constantly rolling, what we do is we sell a third, a third, a third. So as the stock starts going in the money, that's the reason selling is the same thing as basically reducing your risk reward. Right. And so, and so that's how we're, instead of rolling, because the point is going to consistently move on the options chain. As the stock is moving, the point is moving. Well, we don't need to keep rolling and rolling and rolling. We just start selling a little bit, layering it off. Does that make sense?
Yeah, that makes sense. And I think that you answered the next question that I was going to ask, but let me make sure. So you bought for $1, it gets to 350, and are you selling all of it because it didn't like the reward to risk is skewed, or you're like piecing out of the majority of it and allowing that last bit to then
That's
run
the part.
5?
Yes. You should be out of most of it by 3.5, because at the end of the day, I'm not sure it's going to be 5 exactly. It could be 10, right? News comes out and starts catching momentum. These things can go up, way up, right? And so,
Right.
and so nobody's sure about the exact target. That's why the confidence is never 100. Right? The confidence part is nobody's ever sure, but you're trying to sort of gauge where it could be, or in your world, technical world, where's the resistance, right? I'm thinking it's going up $10. The resistance is a lot of resistance here. Maybe I start peeling it off a little bit more here. That's where the trading comes in, right?
So is that in general, is that like how you would do it, where like you're halfway to the ultimate target and you're taking half off at that level?
Think about it. If I've taken off, I'm saying $1, right? I'm saying $1 to say $5. That's what we're targeting. So we're buying this option for $1. The option goes from $1 to $2. I'm telling people at 100%, take off a third. Okay. Now they've taken off a third. They have 2/3 left. It goes from $2 to $3. What are they doing? My instructions: take off a third. Just take it off. You're starting to get to where we know, we think it's going there, but we're not sure. Market has a bad day to think everything collapses. Those calls goes from 3 to $1, back to $1, and you didn't take anything off. It's gonna be a hard climb to go back from $1 up to $5. So from $1 to 2, take off a third. From 2 to 3, take off a third. Now do whatever you want, Mike. 3 to 5, you want to play it to 5. It might go to 10. And let that third run with maybe a rolling stop. Right? It goes from 2 to 3. You sell the second third, and now you have 1/3 left. It goes to 3.5. You're thinking, you don't do anything. Next day it opens 2.25. Okay, you know what? Rolling stop. Maybe I get out of 2.25. That's my trade. I averaged on that trade probably about I would say 170%. Okay, so now you average about 170% on a trade. Think about this. You can average. You bought an option. You average 170 on a trade. If you're losing 3 times at 50%. You're still up a small amount. So you traded 4 times, 4 different trades, 4 different stocks. You won only 1 time. You made $100.70 on your dollar option. Okay, you lost 3 times and you lost 50 cents at 3 times. You're still up on those 4 trades by 20 cents. That's what we do at Options Geek. We're not trying to focus on any one trade. We're not hoping any one trade is the next big winner, that this is the one that we're going to retire on, that this is the trade that's going to make it. It's about a process. And what we're doing here is sort of trying to trade a process, right? And what I would say to your viewers, whether it's my process sort of and I could talk about that, but it sort of goes towards unusual options activity, and I could talk about why that's important and what I'm doing there. But our process is looking at unusual options activity and then playing a probability game around it. And again, the probability game takes, judge it over 3 months, over a year. And I can tell you the last 3 months has been tough. It's been very choppy out there. Things are getting stopped much quicker than they have. Things are moving up and down 5-10%. So it's been a little bit choppier. But at the end of the day, if you win one or two times, let's say we win on one trade 400% because it gaps up, and we win one time, $1 goes to $5 on a gap. That's $4. Think about how many times you have to lose managing your losses, taking a shot here, taking a shot there, managing your losses at 50-cent losses. You could lose 8 times in a row, losing 50 cents, and you would break even over 9 trades just because you won on one trade 400%. So buying options, the way at OptionKey, how we look at it, we're looking for the big score. We're looking for those big trades. We're looking for the 200, 300% winners, because we know that when we hit that 300% winner, it wipes out a lot of the losers, and we're taking shots. And I'm teaching people how to do that. I'm teaching people how to look at things, how to look at the world, how to take unusual options activity and extract the target stock price. Because we could look at any unusual options activity and take out, because we can take out the customer or the hedge fund manager's target stock price, right? We can back it out because the chain is a two-way function. The option chain that I built, it's a two-way function. If we understand that it thinks like the hedge fund manager and we know what he bought, then we could back out how to get that pointer right to where that option is being pointed at. That strike is being pointed at, right? So we could just start sticking in target stock prices and say, this guy's thinking right around here. And if he's thinking right around here, do I think that? Can I get there with my techno analysis, with my own process? So these are the different things that people can do. I tell people unusual options activity is super valuable. Whether you want to follow the trade or not, it should alert you to when the big guys are coming in, when they feel like they got the advantage.
And where do you go to find that unusual option activity?
So there are a lot of different sites out there. There are a lot of different sites. I'm in the process of putting together a board that people can do that as well. So that's something that most people don't know. I'm telling you guys now, but that's something that I will have in the next few weeks. An unusual options activity board. At Options Geek, we'll have an unusual options activity board. And what I'm trying to do, and I've put a lot of thought into it, is how do I make it easy for Michael to find an idea every day, right? Every single day, there are some amazing ideas being traded. How do I make it easy for Michael to find that every day? So I've built a board and a process, and I've made it easy. And I can tell you that over probably in the next few weeks, I will have, I've put together a podcast. So I will be putting everything we're talking about here. We'll be talking in the podcast, but we'll be using real ideas, real flow, analyzing the stocks in real time, and giving my thoughts on risk reward, on the option play, on what the hedge fund guy might be thinking about that trade, why he's picking that one, what else is he looking at, what else is he seeing. I think that could be valuable to your audience, and something that you guys could chew on and in your chat rooms and talk about the different things. So, that's coming. I'm putting it all together. It takes a lot of time, but that's the next step and the next evolution, if you will, in Options Geek, to try to make things not only affordable to people, but accessible. And, it'll be free. It's a free podcast. And the tools, I'm going to try to put out there, and I'm debating on whether or not to put it out there all for free.
Yeah, that's fantastic. I can't wait. Well, what's the name of the podcast?
The podcast is going to be called Winning Picks, the Winning Picks podcast.
The Winning Picks podcast.
Yeah.
When do you think it's going to be live?
Probably in the next, I would say, shooting for the first week in November.
First week in November on my birthday.
Shooting for that. Yeah, shooting for that.
Birthday.
Yeah, exactly. But yeah, I think I have some kinks. I'm gonna have a partner. What I've done is I found someone who I like, and I'm not going to be talking to the audience. I'm basically will be teaching my partner on the podcast. So it'll be two of us. I will be teaching that person, helping him. We'd be talking through ideas each day, and the audience would be a fly on the wall, and be able to ask questions. And, so everyone will be a fly on the wall on me teaching someone options and how to look at the world and, analyzing different trades and doing all that. So
That's a great idea. I love it.
yeah, that's sort of been the mastermind work for the last couple of months. We've been trying to put things together to sort of build a bigger audience and then find people like yourself to sort of, I know I told you this when I first met you. You're very good with, there's an element that doesn't get a lot of focus, and that's sort of how the mind works and how the mind thinks and how, you could go on tilt. Like I'm using poker terms because I'm in Las Vegas, but you can go on tilt because you were supposed to win the hand and one card came out and destroyed your whole, chances of winning, and you lost a big pie, and now you're just reaching and reaching and reaching. So you focus a lot on that, and I always applauded you on that. That I think it's great work, and I think it is. A lot of times, a lot of people say, profits are between the head. Making profits are between the head. It's not really on the screen. It's really between the head that you gotta fix, right? Or everything I've told you today is simple math, second grade math, third grade math. Ultimately, it starts becoming between the head. You have a plan, stick to the plan. How do you stick to the plan? Formulating the plan, people could do, and you can learn. But it's being in that zone where things that you teach about, mental health, about physical health, about eating right, about being positive, about, now we talk about, if big investors, they give money, lots of money to hedge funds. Do you know if a hedge fund was getting divorced, hedge fund manager was getting divorced, people pull their money because they realize he's under a lot of stress, he's distracted, and they pull money. They pull money because they know that mentally he may not be there. That why do you think the big investors, when they're going to give 25 million to someone to manage or 50 million, some of them stick private eyes on them hedge fund managers, follow them around for 3 weeks. I want to know what they do on, outside with my money. I want to know where they're going, what they're doing, what they're doing at nighttime. Are they drinking? Are they going out clubbing at 2:00 in the morning on a Tuesday night in New York? I don't know. I want to know, it happens. I mean, somebody's going to take $50 million and manage it for you. You want to know, is this guy fit to manage my money? So hedge fund managers, you could see many of them are, they have their process and way to do things, but they're also, they do a lot in yoga and meditation and all of those guys. You'll see they have psychiatrists come into the room and just talk to them and get things out of it. All of them. It's not a fantasy. What's the guy, Bobby Axe, has on Billions, has a psychiatrist as one of his partners. It's a mental game, and you always need that sort of support on people don't realize sometimes they're veering off the highway, mentally, and you need someone just say, hey, get back to what you do best, get back to spotting those unique points in the technical analysis and then focus on that. And if it's good and we like it and you want to leverage it a little bit, throw in an option in there. That's you got to stick to what and stick to the game and make sure the mind is fixed between the ears.
Absolutely. Oh, my friend, we're at the hour mark. So I know you're on vacation. I don't want to take up too much more of your time. I really appreciate everything that you came on here and shared with us, and it's always a pleasure having you on, man.
No worries. I can answer one more question. I'll give you one more question real quick.
All right. Let's see. Let's go to the chat. See what you guys can come up with on the fly. Raymond was asking, can you show us how you trade? I think the best way to see that is to go check out Options Geek, right? And you've got so much free content on there already. Like, it's kind of mind blowing.
So much. There's so much out there. There's so much out there that I put a lot in the free membership area. Everything I talked about today, there's a lot there. There's all the trades we took for the last, 18 months are on the site. So you'll be able to see that. I think that, you could see for yourself, you could see how many times you're winning, how many times you're losing. You could see sort of results and get a feel. People who sell options, they win a greater percentage of the time. And so those people may not feel comfortable with the strategy of buying options. Buying options, you lose 60, 70% of the time. Okay.
Mm.
And you got to get comfortable with that. And it's you could play with lower stakes. You could play lower when you're selling options, which by the way, I'm not against selling options. There's times to sell options. And I think one of the things that we talked about was, finding opportunity in a high volatility name, in a high volatility environment. Some people find opportunity to sell options here. It carries risk, right? Selling options, you're going to win more often than you lose. But when you lose, you're expected to lose pretty big. We're just playing the opposite game so that we can go to sleep at night and say, all right, I only have this much on the table. Doesn't matter what happens in the world. That's the only thing I can really lose.
Mm. I love it. So, what's the best way for people to get a hold of you? And
I think optionsgeek.com offers, in the free membership, there's a lot. There really is a lot. I try to put a lot in there, different ways to the process, how to get in. But jump on Options Geek, become a free member. I will have a podcast, coming out soon. I'm trying to connect the dots. I'm trying to create a full experience for people where it's education, it's tools, and it's, direction. Me sort of helping people understand, connect the dots while they're learning, while they're doing. I'm not a broker, so I tell people you could find a practice site on a brokerage firm, at a brokerage firm, or maybe a brokerage firm has. But I always tell people practice a little bit first. Get to understand my process, and then you can use it on your process, and play around with it. And it's easy to press the buttons. Anybody's going to learn how to press the buttons in 10 minutes. That doesn't mean you understand options. It just, you understand how to actually buy and actually sell. Doesn't mean you actually understand the product. So I tell people, and I lead with education. I've built the best education out there, by far. And I could just tell you that the reason I say that is because even if you spent 100 hours anywhere else, you would come back and I would ask you the simple question. How did you actually choose, or how will you choose the right strike? How will you do that? With everything you know about the Greeks, applied volatility, whatever you study, it doesn't matter. I'll ask any expert, ask the gurus. If people think I'm nuts, but I tell people it's a problem. There's millions of people in the world that are trading options, and not one person can answer me that question. How is that possible? Right? How is that possible? Right? So I tell people, I challenge people, go ask your options guru or whoever you are. I want to buy this option. Why is that the right one? And ask them to prove it to you. Like I prove it to you. Ask them to say, this is the right one because of this. You're not going to find an answer out there. And so that's what makes my education unique. I'm out there trying to build trust and teach people and lead with education, to make people smarter about what they're spending their hard-earned money on. And if I can just do that, that would be a great achievement for me.
I think you're doing a fantastic job, man. Keep doing what you're doing.
Awesome, Mike. Listen, man, thank you for having me. I really appreciate it. Again, you can reach me at optionsgeek.com. If somebody wants to send me an email, I'll try to answer. Felix at optionsgeek.com. Pretty simple. And yeah, and good things to come in the next month, and we'll see.
Awesome, man. Can't wait.
All right. Thank you, Michael. Thank you for having me.
Enjoy the rest of your time in
All right.
Vegas.
Thank you. Be good.
Take care. Bye.